What's up, everybody? Welcome to another episode of Hidden Forces with me, Demetri Kofinas. Today I have New York Times best-selling author Jim Rickards on the program. His books include The Death of Money, Currency Wars, The New Case for Gold, and The Road to Ruin. He is the editor of the Strategic Intelligence newsletter and a member of the advisory board of the Center for Financial Economics at Johns Hopkins. He's an advisor to the Department of Defense and the U.S. intelligence community on international economics and financial threats, and served as a facilitator of the first ever financial war games conducted by the Pentagon. In this episode, we cover financial history stretching back to some of the earliest economic philosophers, and we explore the deregulation of the financial system from Bretton Woods through the financial panics in Asia in the late 1990s and the financial crisis of 2008. We also address one of the greatest weaknesses of modern economics, namely the desperate need for better modeling, and what complexity theory, Bayesian analysis, and behavioral psychology can tell us about our world. We end with projections about the future and why Jim believes the next crisis is bigger, runs deeper, and is much closer than most of us might imagine. Here's our conversation. Jim Rickards, thank you so much for being in studio with us.
It's great to be here, Demetri.
It's very exciting. So I realized when I was preparing for this interview today that I have not interviewed you myself before. You were not on my radio program ever, correct?
Right. I was on your TV program quite a bit. You were the producer and on air, but usually my interviews were with
Lauren Lister.
Lauren, exactly. So that's the first time you interviewed me. Yeah, although we worked together a lot.
I had intended to look into my email. I didn't look, but I think I reached out to you in October or something like that when I was building my show list.
Right.
So you were one of the early guests, I think, in November, and you had come on, and we were talking about Currency Wars, which was your first book, and now I've got your fourth book in front of me, and I told you I wanted to wait till do this until we were talking. Look at how I annotated the shit out of
that. Is the real deal, Demetri. You've got
That's more than the real deal, man.
Stickies, liner notes.
Is that Cyprus 2012-2013 bail-in versus bailout FSB Brisbane G20.
Man, you did a deep dive. It's funny, when you do interviews, I've done quite a few interviews about the book. You can tell within 30 seconds if the person has read the book or not. And I don't, look, people are busy and I don't expect every anchor to read it.
Oh, man, I read it.
I read
Look at this Bayes theorem.
Exactly.
Look at that, the dice.
You
I
got
put little dice things
You got your
here.
own equations. You don't even need mine. That's cool.
I loved it. Well, we're in sync. I mean, we're in sync with a lot of stuff. There's a lot of stuff in here that we're in sync with, and it's interesting because I've had a couple of other guests on the program who, one in particular I'm thinking of, who I just interviewed right before you, and there's a community of people, and this guy's a theologian, philosopher, but there's a community of people that understand the market, understand finance, understand the economy in a way that is similar, and if anything, it's contingent on not having learned conventional economics, because we're going to get into that, because I'm with you all the way on your modeling.
I consider having a PhD in economics from a major university to actually be an intellectual disability. You ought to get your own parking space for that. But it stands in the way of understanding how the economy actually works. You go back to the 19th century and the 18th century and look at the classical economists, people who really figured it out. Adam Smith, even before that, David Hume, John Stuart Mill, David Ricardo. They did not have PhDs in economics. It wasn't even called economics. It was called political economy, if it was even taught. But they were lawyers, they were journalists, they were philosophers, they were mathematicians. They were people who had good intellectual skills and analytic skills, but also had a lot of common sense. And they had a very good read on the economy. Now, sure, things move on, and I'm all for models. I'm for models that work. I'm not in favor of models that don't work. But even as late as the 1930s, 1940s, we had people like Joseph Schumpeter, who had a very good understanding of business cycles. But that all got lost. It all went off the rails, I think, right in 1947 when Paul Samuelson invented neo-Keynesianism. I like to say I love John Maynard Keynes, but I don't like Keynesians. I think Keynes himself was a pragmatist and was interested in what worked, not in dogma. But all the things done in his name, if he were alive today, he'd be spinning in his grave.
That's typical, though. The people that come, the eons, the ones that attach to a particular person. They then develop philosophies around them, use their stature as credibility. So listen, I'm trying to think how, or I did think, I should have thought how I want to do. Okay, so this is how we're going to start. I've been sort of out of the loop. I brought myself a little bit back into the loop. I stay in touch with sort of what's happening in the world, but this is something where I wanna recap because I've been looking at the conversations that the media are having, and what I'm seeing is pretty much the same. And I looked at total debt, the best figures I could find from the BIS, debt to GDP numbers, total debt numbers. Those all those things we're in worse condition there than we were before. Consolidation in the financial system worse, complexity in the financial system worse. And the central banks still being at very low, near zero interest rates, and also being the sort of only game in town. That's still being the mimetic structure of conversation in the financial press remains the central banks. I guess I would bring us up to speed on where we are, and also if you want, why don't we talk about sort of also how we got here? Because I read your book, and it sounds to me like you really start the clock around the disintegration of Bretton Woods. That's how I think of it, at least. But why don't you just kind of let's go. Why don't you just take us by the hand here?
Well, I love economic history. In addition to doing up-to-date 21st century economic analysis, I find history as a big input. And you can pick your points. You can look at 1914, which was the end of the classic gold standard. You could look at 1944, creation of Bretton Woods. You can look at 1971, 73 period, pretty much the end of Bretton Woods, the King Dollar period. You can, in my new book, The Road to Ruin, I actually have, I talked about history, and there's quite a bit of history in my first book, Currency Wars, but I actually have a sequence of financial collapses, a sequence of 3 starting in 1998. That was the Russia, Asia, long-term capital management crisis. I look at 1998. I then come forward 10 years to 2008, talk about that. And then I come forward 10 years again to 2018. Now, 2018 is obviously a literary device. I'm not saying that, on January 1st, 2018, the world's coming to an end. I'm not saying that. What I'm saying is that 10-year tempo is a realistic way to think about the periodicity of financial crisis. But I also make the point that the next crisis is coming. It'll be worse than 2008. It could happen tomorrow. I'm not saying it's going to happen tomorrow. What I'm saying is it could happen tomorrow, and if it's something you're concerned about, and investors and anyone with any wealth to protect or any citizen should be concerned about it, what are you waiting for? You need to start thinking about it and preparing for it now. So whether it's 2018, 2019, or tomorrow morning, could be any of the above. It doesn't matter. What matters is it's coming. It's going to be worse. The reaction function is going to be different, and that's what I talk about in the book. So any of those are useful starting points. They all mean
all right. Let's start with
things.
Let's start with the Asian financial crisis and Russia, the Russian crisis, and LTCM, and then we'll get into your predictions about 2018 because I want to talk about some of the models that you use to make your projections.
Sure. Well, 1998. Just for the listeners to recap a little bit. First of all, that crisis came to a head in September 1998, but it started in June 1997. And that's a very important point because when it starts, you don't know where it's going. Now, a complexity theorist would say, I have a pretty good idea where it's going because of the scale of the system, because of the interconnectedness. Once that first domino falls, it's easy to predict all the other dominoes are going to fall. You don't need a crystal ball or a time machine. You just have to understand the dynamics of the system, the array of actors or agents in the system to make some very good forecasts. But most people are not doing that. So in June 1997, the Central Bank of Thailand depegged the Thai baht from the dollar. So they had a peg to the dollar, and people looked at that and said, well, I can borrow dollars and invest in Thailand and get a higher return.
Carry trade.
Carry trade. And what do you worry about in a carry trade? Well, you worry about short-term rates in the short position going up, so short-term U.S. dollar rates. So that was not a concern at the time. And you also worry about the exchange rate, but here you had the Central Bank of Thailand saying it's pegged, and you can always get your money out at a fixed rate. So people were doing golf courses and hotels and resorts and other kinds of investment, et cetera, in Thailand like crazy. And then all of a sudden, people started to get their money out, the reserve position drained, central bank blew a whistle, timeout, and broke the peg.
And the panic that ensued in Thailand was a direct result of the fear of the initial boom as a result of the stability that was created by the peg and the environment, and the overinvestment in Thailand caused a lot of anxiety around malinvestment and potential losses.
Correct. There was a loss of confidence there, and people wanted their money out. Now the point is, that was a crisis in Thailand, and maybe if you were an investor in Thailand, you got your money locked in, or the value of your golf resort went down, et cetera. But nobody at the time thought that this would get to the point where global markets were hours away from a complete shutdown. And that's where we were on September 29th, 1998. Now, the reason I know that, it's history, but I was the lead counsel, general counsel for Long-Term Capital Management. That was the hedge fund that got caught up in it the following year. I negotiated that bailout. I was in the room with officials from the Federal Reserve and the Treasury and other government agencies, as well as the heads of the 14 biggest banks on Wall Street, and a whole thundering herd of lawyers when we did that bailout. So I know how bad it was, but no one thought that at the time in June 1997. So what happened after that? It then spread to Indonesia. People said, well, if Thailand's a problem, maybe Indonesia's a problem. Get my money out there. Malaysia, South Korea. So it began to do, this is what they call contagion or spillovers, dominoes falling, if you want to think of it that way. It began to spread throughout Asia. And, the old expression, the time to invest is when there's blood in the streets. Well, sadly, tragically, there was literally blood in the streets. People were killed in demonstrations in Indonesia and Korea, Seoul, Korea. It led to the collapse of the Suharto government in Indonesia, which had been there for decades. But then by December, it seemed to calm down a little bit. We went into the winter, and it almost looked like it was over. And I was, my colleagues at Long-Term Capital were saying, is this a good time to invest in Indonesia? Because things have kind of fallen off the cliffs. But by April of 98, so now we're almost a year from the original devaluation, it started to reemerge again. And then it reemerged with a vengeance in Russia. And August 1998, Russia defaulted on their internal debt, their external debt, and devalued the currency all at once. It was just a huge shock. And then that caused a liquidity crisis, spreads widen. And the IMF and people in the International Monetary System were looking at the sequence. Again, I analogize the dominoes. So they said Thailand, Indonesia, Malaysia was in it, Korea, Russia, and they thought Brazil was going to be next. Brazil looked like the next domino to fall, and the IMF started to build a firewall around Brazil, get ready for an emergency liquidity injection, et cetera, conditionality and all that. But up popped Long-Term Capital. Nobody thought a hedge fund. They were looking at a row of country dominoes. Nobody thought that there was a hedge fund domino in there, but there was. And then that became the eye of the storm. By September 1998, we were looking at, and that was bailed out by Wall Street, although I should put the word bailout in quotation marks. Wall Street didn't bail out Long-Term Capital. They bailed out themselves. What they did is they came up with about $4 billion, all cash. They bought the balance sheet. From then on, they owned it. And then they did an orderly unwind instead of a disorderly unwind. And they actually they got all their money back with a slight profit. The losses were on the prior investors, including the partners at LTCM, which is appropriate. They ran the fund. They should have suffered the losses. That was actually a fair result. But Wall Street wasn't doing anybody any favors. They were bailing themselves out. But that deal went through. It closed, and life went on. In fact, after that, the Fed cut interest rates twice. The stock market rallied late 98, 1999. That was the dot-com boom, if you recall. There was no economic recession.
And that was right after Greenspan had to walk back his irrational exuberance comment.
Right. He made that in 1996, and then by 98, it was kind of like, well, whatever, and it's going to do what it's going to do. That is an interesting sidelight, by the way, Demetri, because it has to do with the Fed's reaction function to bubbles. That was actually the origin of the Fed saying, we're not in the business of popping bubbles. We're in the business of cleaning up after the bubbles pop. And Greenspan did that in 2000. The dot-com bubble did pop in 2000. The NASDAQ fell 80%. And other markets fell by comparable amounts, not quite 80%. But then Greenspan, cut interest rates in the early 2000s, kept rates low. Too low for too long, really set us up for the next crisis, but that was yet to come. But he sort of validated the theory that the Fed didn't have to pop bubbles. They could clean them up after the fact. I talk about that in my book as well. That the theory is flawed because it has to do with the difference between leverage bubbles and unleveraged bubbles. The stock market boom in 2000, the dot-com bubble, was not leveraged. They might have had a little margin money in there, but basically it was equity and it was not a lot of leverage. 2008, on the other hand, was leveraged 20 to 1 or more. And when you pop that bubble, you get a very different result than when you pop an equity bubble, because there's not enough money to go around. There's not enough equity to pay off all the creditors, and you get a liquidity crisis and a global panic, which is what we saw. But coming back to 1998, so that deal went through. The world did not come crashing down, but it almost did. We were just hours away from closing every stock and bond market in the world.
Can you explain to our listeners a little bit, so for people to understand that? And 2 points. I actually want to say something. LTCM was using a Gaussian distribution in their model for trading, right? Which is an important point that will circle back around when we speak about predictive modeling. Gaussian distributions are normal distributions. The idea that if you have a certain number of events that are out of the norm, you can keep betting that you're gonna get back into the average. They were doubling down, tripling down that things were going to return. Right.
It's a bell curve. It's mean reverting. It's called a Gaussian distribution or a normal distribution. It's got a couple different names, but that's exactly right. And the problem with that, first of all, it's not true. It's empirically not true. We don't have to debate it. If you look,
it's true in the case of people's height, in the case of heights of people, but not in the case of market prices.
There are some things that are normally distributed: height, weight, IQ. There are a bunch of things that are that accord. Coin tosses. You start tossing coins and getting heads or tails, and you don't know what the next one's going to be. But if you do it 1,000 times, you're going to come really close to 500 heads and 500 tails. Might be 498 heads and 502 tails, but it's going to be somewhere around there. That's normally distributed. But you're getting to something important with that example, because each previous coin toss does not affect the future coin toss, unless you're saying there's something I have to re-examine my model, which is the Bayesian theory. Well, correct. Bayes is a tool to do predictive analytics when you don't have a lot of information, but it's not really tied to normal distribution per se. It's a tool. But going to your point, and this is attributed to Markov, that when you have something, a draw of cards out of a deck, or a spin of a roulette wheel, or a coin toss, or a roll of the dice, subject to, however many faces or combinations are in a pair of dice, or heads and tails on a pair of coins, or whatever the combinations are on roulette, the next turn of the wheel, the next roll of the dice is not predictable, but over a long enough sample, you can be highly certain that you're going to get a certain distribution. And if you're in markets, you can bet and lose, double your bet, lose again, double your bet again, lose again, and double your bet, and then win. You're gonna win eventually if you have a normal distribution, subject to two conditions. Number one, you better not run out of capital. That's what happened to long-term capital management. I mean, the fact is, the trades that long-term capital management lost money on, those trades ended up making money. In fact, there was always a high probability that they would. But it doesn't mean you can't lose all your money in the meantime. You can lose all your money waiting to make the money. And that's all that happened as the Wall Street stepped into the shoes of long-term capital investors, and they did, in fact, make the money about a year later. You could see that coming, but you didn't know when. So the first condition is you need very deep pockets, and then you need to be able to keep playing the game. And that's what happened to the Hunt brothers in 1980. The regulators, the Commodity Futures Trading Commission, the exchanges called a timeout, said game over. Well, if the game's over when you're down and you don't get to make the next bet, that's another way to lose. So, you can be right, but you have to be solvent. Right. So those are the problems with it's called a martingale, by the way. That's the name for doubling down. Eventually you will win, subject to those conditions which we mentioned, which is it's not game over and you have enough money. But that's not even how markets work. In other words, but the problem is, people think markets do work that way, that normal distribution is the basis for Wall Street risk management to this day. Value at risk is, which is VAR. The main tool, VAR, that's the main tool, is based on that. Which is what's still being used to measure bank capital. Correct. Well, what they do is they look at your balance sheet and then they stress test it and say, what's the worst that could happen, and with a certain probability, and if that is highly remote and you have enough capital to get through it, then you're good to go. That's completely flawed. The people doing those tests misapprehend the statistical properties of risk. They actually don't know the worst that can happen. The worst that can happen complexity theorists would say, tell me the scale of the system, and I will tell you that the worst that can happen is an exponential function of scale. That, by the way, is not just a theory. That's actually, there's a lot of math and a lot of empirics to back that up. Demetri, when you look at the time series of prices, I mean, what's more empirical than saying, okay, give me a ticker, whether it's second by second, minute by minute, hour by hour, pick your periodicity, tell me how prices move, graph it out. What is the shape of that curve, what's called a degree distribution? Well, I'm sorry, it's not a bell curve. It just isn't. This whole, everything about risk management, everything about banking regulation, everything about trading is based on a false premise. It is a curve. There is a degree distribution, but it's something called a power curve. And the debate between a power curve and a bell curve is not some dry academic debate about the shapes of two curves, because those curves represent completely different dynamics. The curves are just representations of a degree distribution. It's the degree distribution that is the underlying risk in the system, and those dynamics are completely different. So it should come as no surprise that central banks blunder time and time again.
Yeah, I mean, you're really nailing something, which is that on a fundamental basis, the models and the methodologies that have been developed in the economics profession and in financial markets simply don't match up with reality. And of course, what is a model? A model is an approximation of reality. They are not near approximations of reality. And with respect to what you were saying, they're effectively talking about these extreme fat tail events. The reason that we consider them fat tails is because we're thinking about normal distributions, which is what they are not functioning within. The other thing I wanted to say when we were talking about the Gaussian model is about, how could an event like long-term capital management, a $3 billion fund, something like that, how is that going to collapse global markets? And what that brings us back to is a fundamental fact, which was the issue with Lehman, which is that financial markets function on a matter of confidence. And fundamentally, that is what allows markets to function because they're leveraged. No one has, we're not functioning off of capital that is there, that is available to be pulled at any moment. Right. And that's what a classic bank run is. But today we're talking about, the runs that we've experienced don't happen at retail banking. They happen in investment bank. They happen in derivatives markets. Right.
Well, the thing with long-term capital you mentioned, the total losses there were just under $4 billion. It was about $3.6 billion, and that's the amount that Wall Street put in to prop up the balance sheet. But that wasn't the issue. The issue wasn't, would Wall Street lose $3.6 billion? That firm was on balance sheet. So on balance sheet was leveraged 20-1 at the beginning of the crisis. Now, toward the end of the crisis, it was leveraged 100-1. You hear that number a lot. But the reason it went to 100-1 was not because we were adding positions. It was because the capital was shrinking. You were dividing the denominator or the fraction was shrinking. So, of course, you're going to get a higher leverage ratio. So it started out at 20-1 on balance sheet. At the end, when the bailout was closing, it was closer to 100-1. But that doesn't tell the whole story because the off-balance sheet was $1.3 trillion. So imagine $1.3 trillion of derivatives poised on a $3 billion sliver of capital. Now you get the idea. Now we're talking 300-1 or more. So that was really the problem. And just to give a very simple example, long-term capital was very well known for trading fixed income, derivatives, arbitrage, arbitraging government bond markets against futures, government bond markets against options. And
they had a lot of counterparties in these derivative positions that they were using to net their risk.
Correct. About 70 major counterparties, probably. Most of the trades were concentrated in about 40 names, but these were all the biggest banks in the world. So the idea that LTCM was big in fixed income and fixed income derivatives and arbitrage, everybody knew that. But what they didn't know was that long-term capital was the biggest risk arbitrageur in the world. Risk arbitrage is betting on stock takeovers. So, company A is going to buy company B for a certain dollar amount per share, and that's announced, and your risk, it's called risk arbitrage. You look at that and say, well, okay, company B is that stock's below the takeover price. So if I buy that, if I short company A, go long company B, I own the spread. I wait for the takeover to go through. The price it converges. I unwind. I make a profit. If it happens, of course nothing's risk free. But the idea is, I'm taking a little bit of risk to make a lot of profit in that deal. What's the risk? Well, the risk is that the deal doesn't go through. The risk is the deal busts, and then instead of converging, those prices move back in opposite directions, and the target company stock collapses, and you lose money. So that's the risk. And smart people have developed models and ways of thinking about companies and talking to management and doing a lot of fundamental bottom-up research to figure out that risk. Long-term capital didn't do that. They did a couple of things. They just kept betting. And they said, look, we know a certain percentage of these trades are going to bust, but if we do enough of them in enough size and do it persistently, we will, in fact, make money because on average, you do. So that was kind of going back to what we said earlier about
average sample size
and the martingale. But the other thing we did, we never owned a share of stock. We did it in derivative form. We had a what's called a total return equity basket with Bear Stearns, which was our prime broker. So we would literally just call up and say, we were in every big risk arbitrage deal of the day. Go back to late 1998, what were the big deals? WorldCom, MCI, Citigroup, Travelers, Lockheed, Boeing. These were the big deals of the time. We were in every single one, up to 4.9%, because beyond that you had to make a public disclosure, and we didn't want to do that. So we capped ourselves at 4.9%. But these were giant deals. And we did it all in derivative form. So we would just call up Bear Stearns and say, hey, put a million shares of Lockheed short in the basket. Boom, there it is. Well, Bear Stearns was doing that trade with us in derivative form. They would have to go out into the market and buy the Lockheed. In other words, if they were short to us in the basket, they'd have to go long the actual shares, and then they would have a hedge position. They would make a profit. Well, picture that setup. Now imagine LTCM disappears. We file for bankruptcy in the Cayman Islands, and boom, we're gone. All of a sudden, Bear Stearns is long billions of dollars of Lockheed stock that they got to dump. And that was the problem. All the Wall Street counterparties would have had to dump all the stock that they owned because they thought they had a hedge position because long-term capital, they were short to long-term capital. Well, try dumping $15 billion worth of stock. That's what we had, $15 billion. And I'll never forget Peter Fisher, who was head of open market operations at the Federal Reserve Bank of New York at the time. Bill McDonough was the president, but he sent Peter Fisher up, and Gary Gensler, who was Assistant Secretary of the Treasury at the time, came up to visit us in Greenwich at Long-Term Capital Management. This was before it was really big in the headlines. We actually called them and said, Houston, we have a problem. We didn't expect a bailout. We didn't ask for a bailout. We were kind of incredulous. Like, well, why should you bail out a hedge fund? We thought we were just being good corporate citizens. Like, there's a problem here. You're the regulators. You ought to know what it is. So they came up. It was on a Sunday, and Gary Gensler, Peter Fisher, Peter's assistant, Dino Kosh, John Merriweather, and I sat down in a room for 5 hours. And we just turned pages. We had printouts, and we just went through position by position by position. At the end of it, Peter's face was white, and he looked at us, and he said, we knew you guys would take down the bond market, but we didn't know you would take down the stock market, too. They had no idea about the $15 billion of equity positions. So it would have shut every market in the world if the bailout didn't go through. That's how close we came. So we survived that. Life went on. Stock market reached new highs. Then you had the dot-com collapse. Then, so come forward to 2007. Actually earlier, in 2005, 2006, I could see the same thing happening again. I was giving lectures. My books weren't out at the time, but I was a regular finance lecturer at the Kellogg School at Northwestern. I gave a lecture at the Applied Physics Laboratory, actually, because a lot of the models I use are from physics.
Alamos.
That came later. This was actually the Applied Physics Laboratory down in Laurel, Maryland. But I was out there warning. Now, I didn't say, gee, it's going to be mortgages. It's going to be, the spring of 2007. I wasn't that specific, but I didn't have to be. I could see the instability in the system. I could see a greater collapse was coming. I was warning about that based on system dynamics. You didn't have to hang it, could have been mortgages, could have been something else. It didn't matter. It's that the system was unstable. That's what I was saying, having lived through it the first time and having done quite a bit of research in complexity theory, physics, graph theory, network theory, applied mathematics, Bayesian statistics, et cetera. In the meantime, I kind of mastered all that to the point where I could understand capital markets differently than everyone had done before long-term capital. So what should have happened after long-term capital? When you look at what went wrong, what should you have done? Well, you should have banned derivatives, most derivatives, not 100%, maybe the old style Chicago futures, heavily margined, watched very carefully, well risk managed. Maybe they're okay.
Let's actually, for those listeners who are not fully familiar with this, when you say ban derivatives, or put regulations around derivatives, what you're essentially saying is derivatives are good so long as. And what is a derivative? A derivative is essentially a bet.
It's a bet.
It's a bet. It's a bet on an underlying asset that you don't have to own.
Correct. It would be like if you and I went to the racetrack and there were real horses and a real betting window and we put up real money and we made a bet. Okay, people understand that. But what if we were, in some bar 5,000 miles away and I just said, hey, Demetri, let's make a side bet. We're not going to go to the racetrack, the pari-mutuel window. We're just going to make a bet. And then I take your bet and sell it to somebody else and she sells it to somebody else and so on. So you can see that there's a lot of bets out of one race, and nobody put up any money after the first one. We got a lot of debts to settle if anything unexpected happens in that bet. Well, that's all derivatives are. They're side bets on a market. So we kind of understand stock markets and bond markets. These are just side bets, but the problem is you can't see them. They're non-transparent, and there's no limit on the leverage.
And they're over the counter.
And they're over the counter by and large, and that's what causes the instability. And just to Now, I remember in 2007, by the way, interesting, because I talked about the 98 crisis, and then my next crisis I talk about in The Road to Ruin is 2008. But very similarly to 1998, which really started in 1997, the 2008 crisis started in 2007. Now, everyone remembers September 15th, 2008. That was the day Lehman Brothers filed for bankruptcy. So everyone looks at that and says that was, ground zero in the crisis. But that actually started in the spring of 2007, over a year before, when the first signal, some insiders saw this, people like Kyle Bass and others, anyone saw the movie The Big Short, knows that there were people who were onto this. But as far as the general public or average investors are concerned, the first clue was in the spring of 2007, HSBC, and because it's a public company, announced that its earnings, they lowered their earnings expectations, and they specifically said, we're losing some money in mortgages here.
What an amazing time.
Well, that was an alarm. And then at the end of July, there were two Bear Stearns hedge funds that actually went out of business. It wasn't Bear Stearns itself. That happened.
A couple of Cayman Island
that
funds.
happened in March 2008, but these two funds went out of business. Then SocGen, Societe Generale, suspended money market redemptions. That was a shot across the bow. And then, of course, we had the famous rant with Jim Cramer and Aaron Burnett on CNBC. Cramer was screaming, they know nothing, they know nothing. And he was right. He was absolutely right. The Fed was completely clueless. Well, that's when it started. But think about the fact that you had some signals in the spring and the summer of 2007. Then you had some real stress. And then by September of 2007, remember Hank Paulson, Secretary of the Treasury, came up with the Super Civ, Civ SIV, a special investment vehicle. These were these off-balance sheet structures that Citibank and others had come up with for their credit card receivables to keep them off the balance sheet of the bank. And they were funded with commercial paper. Commercial paper started drying up. It looked like they were going to implode. And Paulson had a roll-up strategy. He said, let's take all the Civs, you're all in trouble, and roll them up into what I call the Super Civ, and we'll wrap some kind of guarantee around it and make that problem go away. And then what happened? But the other thing they did.
It's so difficult remembering all this.
Painful,
stuff.
Isn't it?
It's painful. It's painful. Please continue, because one of the things I want to get to before we're done with this interview is I want to ask what your perception is about where we are today in terms of that type of complexity.
But that's why, thanks, Demetri. But that's why the history is so important, because if you had learned the lessons in 1998, which we didn't, but if you had learned those lessons, we never would have had 2008. But the problem with 2008 is we didn't learn any lessons either, where things are just as bad. And we'll come to that and why this next collapse is going to be worse than the last one. But so December 2008, 2007, this is still 2007, Hank Paulson gets on the phone and calls all the major sovereign wealth funds, ADIA, Abu Dhabi Investment Authority, Temasek in Singapore, Kuwait Investment Authority, Prince Alawid, all the big money in the world, and says, the U.S. banking system's on sale, and you got to bail it out, and you can get some great bargains here. So remember, Abu Dhabi bought just under 10% of Citigroup, and they did it with an option structure, and they announced it was $35 a share. Citigroup had been 50, by the way, or close to 50. They said it was $35 a share, but they had a bunch of bells and whistles and high dividends and options in there. If you adjust it for all that, it was closer to $24 a share.
You're still overpaid for it.
Well, it went to $2. It was, so 8 months later, it was $2 a share. But my point is, by December, we were feeling good. It was like, hey, crisis is over. Sovereign wealth funds bailed out the banks. They look like Warren Buffett, buying Salomon Brothers in 1991. And it was all good. Well, it wasn't all good. It was exactly like that hiatus, remember, in 1997, 1998. It looked like it calmed down by the winter, but by the spring, it came back again. March 2008, Bear Stearns goes out. June, July 2008, Fannie and Freddie go out. And then, of course, September, Lehman. I remember talk about this in the book in August.
What a time.
Yeah.
What a time.
But I was sitting there watching this like, I've seen this movie. I had lived through it with Longterm Capital.
Shit.
I know that the scale of the system is so big that these are slow motion crises. It's not like two cars hitting each other at head on. I mean, it ends up that way, but it's like, actually, imagine two cars hitting each other, but you're watching it in slow motion. You're like, whoa, those cars are going to hit each other.
My God.
They're heading right for each other. This is going to be really bad. That's how I felt in late 2007, 2008, watching this. But just to illustrate that point, so it's August 2008. We're in the middle of the presidential election campaign. And it's McCain versus Obama, Obama's first term. And I was on the economic advisory board for the McCain campaign. So briefly, it was a very short service. So I get invited onto the call. So, John Taylor and Marty Feldstein, all these big names are all on the call, and I'm on the call and I'm listening.
That's so
and
cool.
these guys are high-fiving because it was right after the Fannie-Freddie bailout, and Congress passed legislation to solve the Fannie-Freddie problem. And they're high-fiving like, thank goodness the crisis is over. Now we can talk about Iraq because, McCain really wanted to run on the Iraq war, being a war hero, war veteran, all that. I said, now we can talk about Iraq. We don't have to talk about this financial crisis because it's over. And so I just bided my time. I waited, and then time came. I said, hi, Jim Rickards. I said, this crisis is not over. I said, you are not going to make it to Election Day without a major financial crisis. This is just dominoes falling, the last domino. So here's what you do. Write the speech right now because you won't have time when this happens. Give it 4 points. Doesn't even matter what they are. You always have 4 points because it sounds good. I said, when the crisis hits, put the candidate on the steps of the Treasury with a microphone and say, my fellow Americans, we're in a crisis. Here's my 4-point plan to deal with the crisis. I said, people will be so reassured you'll be elected president. Well, here's what happened. People said, who's this nut? I got left off the call. I was not invited back. And then, of course, a month later, that's exactly what happened. We had the Lehman Brothers crisis. And if you recall what happened then, McCain ran around like a chicken with his head cut off.
He ran back to Washington.
He suspended his campaign. And then he barged his way into the Roosevelt room, wanted to meet with the president. Well, Bush, 43, he couldn't very well meet with McCain without meeting with Obama. He was a Republican, of course, but he had to be balanced. So he invites McCain and Obama into the Roosevelt room and for this economic summit or whatever it was. Well, Obama didn't actually know any more than McCain, but Obama was smart enough to keep his mouth shut and just look very cool. McCain looked scary. Obama looked cool. If you look, that's when the polls reversed. McCain was leading in the polls up until Lehman weekend. It flipped. Go to Real Clear Politics, poll of polls for that data is available for September 1998. And you'll see, September 2008, you'll see that the polls reversed that weekend. So it pretty much cost McCain the presidency that he was not prepared
McCain campaign has always contended that, indeed.
Yeah, it wasn't Sarah Palin. Sarah Palin was a sideshow. It was the crisis that took him out. But he was warned. So then, of course, we go through the 2008. Now, one more footnote on 2008, Demetri, because I know you want to talk about the next crisis, and so do I.
No, this is great, though. I do want to go through this because this is important.
So when the crisis started in 2007, even into 2008, even when it got bad with Bear Stearns in March 2008, it was looking a little bit hairy, you had really smart people. And I would say like Ben Stein, is an economist and a lawyer, market commentator, but others. And they said something along the following lines. There were $1 trillion of subprime and Alt-A mortgages. I mean, everyone knew that the problem was in mortgages and housing values were going down. And that was the number. There were approximately $1 trillion of subprime, what's called Alt-A. Alt-A are kind of funky, not very good mortgages, just not as bad as subprime. So $1 trillion was the number. Historically, default rates, even in a bad recession, seldom got above 5%. Usually 2, 3%, 4, 5 was really extreme. So what Ben Stein and others said, okay, let's get crazy. Let's assume 20% defaults. Nobody thought it would be that bad. Let's assume 20% defaults. They did the math. They said, okay, you got $1 trillion of mortgages. Let's assume 20% defaults, which was crazy. That's $200 billion of losses. which in real terms was not larger than the losses of the S&L crisis in the 1980s.
They didn't take into account the derivatives market.
That's exactly right. In the 80s, right, we survived that. And they said, we'll survive. $200 billion is a lot of money, but we'll survive. What they didn't know is that there were $6 trillion in derivatives, and you take a 20% hickey on $6 trillion. Now you're talking $1.2 trillion of losses. That's enough to wipe out a lot of banks, which is exactly what happened. So it was the non-transparency, the opaqueness, the blindness of what could happen in derivatives market that caused people to be too confident about what was going on in mortgages.
And the over-the-counter derivatives market was estimated at roughly $700 trillion at that time.
That's about right. It's getting close to a quadrillion. It's actually, interestingly, it's actually starting to come down a little bit. There are other problems, but some of these, but I mean, when I say now, it's very recent, the last couple of years or so, according to the BIS. But yeah, at the time, approximate number was about 700 trillion, which is, not that far from 1 quadrillion.
All right. So 2008 happened. We had the government sort of fiscal bailout, which was the bazooka, the Hank Paulson bazooka. We had the Fed massive liquidity, not just the Federal Reserve, but across the world, central banks. The EU, ECB had the LTROs. It had their equivalent of quantitative easing. We had QE1, QE2, Operation Twist, QE3. Was Twist 3? Anyway, we had plenty. So we've passed all these sort of years, right?
Twist was throwing a bone to a hungry dog. When QE2 was over, the market looked at the Fed and said, what else you got for us? And they weren't ready to do QE3. They said, well, here's Operation Twist, keep you guys happy. But that was a little bone between QE2.
Actually, Twist seemed like it would do more harm than good in retrospect. Even at the time, it seems to me.
Yeah, well, it's all harmful.
It's all harmful, but it's like
particularly
stupid because it made it so difficult even more difficult to unwind it if you're going to suppress the long end of the curve. All right, so not to recount all those inter years, but all right, so tell us now. Sort of, let's continue. Why don't you just keep going with where you were?
Well, as I said, we didn't learn any lessons after 1998. In fact, we doubled down. I mean, they repealed 1999. They repealed GlassSteagall. That was one of the. GlassSteagall had worked almost flawlessly for 80 years, from 1933 or 34 to 1999.
GlassSteagall separation of commercial from retail banking from investment banking.
Correct. I said 80 years. It was about 65 years. But you go back to the 1920s. What was going on in the 1920s? Well, commercial banks were originating garbage loans, securitizing them, and selling them to their customers. So in 1929, the stock market crashed. A lot of retail lost a lot of money. We went into the Great Depression, and Congress had hearings. And they looked at this and said, oh, you guys originated garbage loans and sold them to your customers. You can't do that anymore. They passed GlassSteagall. And GlassSteagall said, from now on, you can take deposits and make loans, and that's a commercial bank, or you can underwrite and sell securities, that's an investment bank. But you cannot do both. There's an inherent conflict of interest. You cannot do both. Well, that worked extremely well for about 65 years. Why the Congress in 1999 thought they were smarter than the Congress in 1933, I'll never know, except the Congress in 1999 was a lot more corrupt. You had, you had sort of the devil's bargain. You had Phil Gramm, senator on the Republican side, and Bill Clinton, president on the Democratic side.
You also had Robert Rubin, former Goldman and Citigroup chairman.
Sure, I think he might have moved on by '99. I think Larry Summers was Secretary of the Treasury, but it was maybe a tail end of Rubin's role as Secretary of the Treasury. I mean, Rubin was certainly a player. You're absolutely right, but the point is they repealed it. So what happened next? Banks originated garbage loans, securitized them, sold them to their customers, and it was an exact replay of the 1920s. Why should we be surprised that 10 years later you blew up the system again? It had already happened, and they fixed it, and then they unfixed it, and it happened again. What kind of learning is that? I mean, this is the problem with public policy. It's short-term, it's corrupt, it's a matter of prevailing self-interest and special interests. No one's looking out for the taxpayer or the everyday citizen or everyday investor.
Well, that's why I personally focus so much on Bretton Woods, because that was sort of the architecture, the global financial architecture And once that big piece of it was taken out, once we went off essentially not the gold standard, but not the classical gold standard, but an
modified gold
effective,
standard,
right?
yeah.
Once we went off of that, it changed the game for everything, and that's when the calls for deregulation began. And then late 70s, all through 80s and 90s, we had a lot of financial deregulation. When, in my opinion, studying the history, I think what should have happened was deregulation followed by re-regulation. I mean, a rethinking of the system. If you're going to go off of Bretton Woods, you have to accommodate for this new reality.
Right. And then, of course, when Bretton Woods failed and it was in state, everyone goes back to August 15th, 1971, which is the night that Richard Nixon said that he actually used the word temporary. That video
Shut
is
the gold window.
on
Yeah,
YouTube. You can find it. But he said, we're temporarily suspending the conversion of dollars into gold by our foreign trading partners. And actually, there were
to protect us from American people from the speculators.
Well, right, exactly. Use the word speculators. That was they spent the weekend at Camp David, and there were about 5 people who were very close to the president who were there. I've actually spoken personally to 2 of them. Kenneth Dam, who was a lawyer in the White House at the time, but later Deputy Secretary of the Treasury, and Paul Volcker, of course, was who at the time was Deputy Secretary of Treasury for International, later Chairman of the Federal Reserve. So the others were, Arthur Burns.
Burns was there.
Chairman of the Fed, John Connolly, Secretary of the Treasury, and the President. So I spoke to kind of 2 of the 5 people in the room, and they, not surprisingly, they told me that they all thought this was temporary. They thought it was a timeout. There was a run on the bank, except the bank was Fort Knox.
The French.
So there was the French, the French, but the Swiss and the Spanish were right behind them. The only people who were playing ball with us were the Japanese and the Germans.
Always.
Because, they needed the nuclear umbrella. They were relying on military protection, so they played ball because they were dependent on us militarily. And then the Brits didn't mess up the system because they had a worse problem than we did. There were a lot of sterling claims out there that couldn't be converted to gold. But, the French, the Spanish, the Italians to some extent, the Swiss, it was just a run on the bank, except the bank was Fort Knox. The gold was flying off the shelves. In 1950, the United States had 20,000 tons of gold. By 1970, we had 9,000 tons of gold. You say, where did that 11,000 tons go? Well, it went to our trading partners. But the pace was accelerating. We would have been out of gold, within a year or 2 at the most, and Nixon knew that. But what he thought they were doing was shutting the window temporarily, exactly like, a circuit breaker on the stock exchange.
Capital control.
Right. Then we would have another Bretton Woods type of meeting, which they actually did at the Smithsonian in December 1971. We would devalue the dollar against gold, which they did. They said, let's make it, at the time, $42 an ounce. And then we'll reopen the window at the new value. Well, the problem is they never reopened. They did everything I said, but they never reopened the window because countries went to floating exchange rates under the, I would say, malign and misguided influence of Milton Friedman, who thought that was a good idea.
Yeah, he was a proponent of it.
Turns out not such a good idea. But we've been essentially unanchored ever since, and we've had one crisis after another ever since, whether it's the 87, stock market went down 22% in one day on October 19th, 1987. I mean, from today's levels, Demetri, that would be the equivalent of 5,000 points on the Dow Jones in one day, not 500. Like if the stock market went down 500 points, it's all you'd hear about. Imagine 5,000 points in one day. Mm-hmm. That equivalent in percentage terms is what happened on October 19th, 1987. That's really the kind of, to me, that's the beginning point of the modern age of complexity, and it's always been complex, but actually going into critical state dynamics. You said at the beginning of the of our discussion, things are more complex. The way I would think about it is that the system's always complex, but it's more critical. Critical is a technical term. It describes the situation in complexity when you're ready to detonate an atomic bomb.
You're at the threshold.
You're at the critical threshold where things are going to blow up. So, for example, let's say I've got a 35-pound block of uranium-235, and it's shaped like a cube, and it's sitting in front of me. Well, it's complex. I mean, it's radioactive. There's stuff going on. Neutrons are firing off and releasing, electrons, and it's creating energy. But it's radioactive. It's complex, but it's not in the critical state. Now, I take the 35 pounds.
It's in a stable dynamic state. Dynamic stability, you call it?
It's I would say it's non-critical.
Non-critical.
I would say it's complex and dynamic, but not critical. I'm being technical only because
Sure.
I don't speak of these things in generic terms. I like to use the actual physics, scientific terms that apply. That's why you'll never hear me, unless someone brings it up, I never use the phrase black swan. Because black swan is one of those things where it's kind of content free. I mean, and Nassim Taleb, met him, read his book, a great book. I think he did a really, really good job of demolishing the bell curve, which we talked about. But then he kind of threw up his hands and said, statistics don't work. You can't model it. It's not normally distributed. I'm a philosopher.
That's sort of the distinction between chaos and complexity.
Well, it's really the distinction between demolishing a paradigm but not building a new one. I would say Taleb did a very good job of discrediting the old paradigm, but he didn't replace it with anything. He just said you kind of can't model this, just get long volatility and wait for the end of the world. And so that's fine. It's not his job to save the world, but I was never satisfied with that. I felt, well, okay, I agree 100% that the old paradigm of normal distribution is wrong. I mean, it's empirically wrong. But I wanted to figure out what worked, what would work. And I found it in physics. I didn't invent the science of complexity. It was invented in 1960. But all I had to do was take the math and theory and import it into capital markets and to get very good results, because it's apparent readily apparent the minute you ask the question that capital markets are complex systems, and so you can use complexity science to understand them. But coming back to this, the issue of the critical states. So I've got my 35-pound block of uranium. It's radioactive, it's complex, it's dynamic, but it's not critical. Now I take it and I shape one part of it. I engineer it into something about the size of a grapefruit. And I take the rest and I engineer it into something that looks kind of like a baseball bat. And I take the grapefruit and the baseball bat and I put them in a tube and I fire it together with high explosives, and boom, now I've got an explosion. I can kill 300,000 people. That's an atomic bomb. Now the point is, it's the same 35 pounds of uranium. It's the same 35 pounds of uranium. But by engineering it, you cause it to go into the critical state. So when I look at capital markets, the scale of the system, the amount of derivatives, the quadrillion dollars we talked about earlier, that's the uranium. But then the question I ask myself is, are we bending it, shaping it, or is it bending and shaping itself? Because there is this concept of self-organized criticality, which is you do it yourself, to the point where we're about to collapse. And sadly, the answer is yes.
And it doesn't have to be that complex, because you brought up it doesn't have to be that ornate, because you brought up LTCM as an example, or Lehman, or whatever. You have these critical points where a small change creates a nonlinear result. You can have a completely critical event in the market. All right, so that's where we are today. Why don't we talk about that? Talk about ICE 9, Global Bailins, sort of everything that you project in your book about where we're headed.
Great. Well, we went through
We did a deep dive.
Did a deep dive on 1998 and 2008. So let's talk about 2018.
Let's do it.
With the warning that it could be tomorrow, and that's the point I make. So we didn't learn lessons in 1998. We got 2008. We did not learn lessons in 2008, so we're going to have another crisis. We have not done what we need to do. I mentioned banning most derivatives. That would be a good start. Breaking up the big banks. J.P. Morgan today, when I started in banking, 5 of the biggest banks in the world are today J.P. Morgan. It was the old J.P. Morgan, Chase Manhattan, Chemical Bank, Manufacturers Hanover. These are all, sound like an ancient history lesson, but these were all big banks in the 70s and early 80s, and they've all been rolled into one bank, and many, many more, by the way. There are a lot of smaller ones.
National City was also a bigger bank then, but then rolled into City.
Yeah, merged with First National Bank and became First National City Bank, and then it became Citibank. And so these big banks are bigger than they were in 2008. So what did we hear about in 2008? Too big to fail, too big to fail. Well, all the banks that were too big to fail are bigger. They're more concentrated. Those 5 biggest banks have a larger percentage of the total banking assets. They're more interconnected. The derivatives books are bigger. And you say, well, so what? Who cares? I mean, isn't consolidation a merger?
Except it goes exactly against the premise of Dodd-Frank, which was to create a financial institution that could be more easily wound down.
Well, that will not survive the next crisis. The thing about Dodd-Frank is everyone said, and I know, Senator Dodd and Eddie Silverman, who was his chief of staff. I know people actually put this together. And they said, we have ended too big to fail because we have this resolution authority and living wills and all that. And my answer is, you haven't ended too big to fail. You have institutionalized too big to fail. You have made too big to fail a way of life because you've given yourself the false assurance that you can deal with it. And based on that false assurance, you've allowed the big banks to get bigger. You know what? There's an old saying. There are a couple of different versions of it. One of Napoleon's generals said, no plan of battle survives the first shot or the first contact with the enemy. I think the boxer Mike Tyson said it. He said, no boxing plan survives the first punch in the face. In other words, you can make all your living wills and all your resolution plans and all that, but I promise you they will not survive a crisis, because in a crisis, people do crazy things. I mean, look, I'm not going to mention names, but I've seen people, had nervous breakdowns, passed out, carried out on stretchers. I can't say anyone died. Well, people did die actually in Asia, but people break down. I mean, the thing about extreme stress, don't forget the human aspect of it. It's like Shakespeare. It can either bring out the best in you or it can bring out the worst in you. So you get frauds, you get people not answering the phones, you get people, locking the door,
jumping out the window.
It's like, oh, wait a second. The plan says you're supposed to do an orderly liquidation. You're supposed to send this money over. And it's like, sorry, nobody home. That's the reality they're going to face. They're just kidding themselves. And it's an excuse to make the big banks bigger and rich. It's why Jamie Dimon's a billionaire, but everyone else is at risk. So
the people sort of in the know, the people in the financial institutions at the top, people in government, certain corners of the world understand essentially that the system is in a critical state.
Correct. And here's what's different. So I talked about these three crises: 98, 2008, and 2018. The next one, in 1998, Wall Street bailed out a hedge fund. In 2008, the central banks bailed out Wall Street. In 2018, who's going to bail out the central banks? In other words, each crisis gets bigger than the one before. Each bailout gets bigger than the one before. We are now at the point where the scale of the collapse will exceed the capacity of the central banks to deal with it. Just to kind of illustrate, I don't like to make claims without, kind of backing up with the data. What did the Federal Reserve do to save the world in 2008? Well, we know they printed almost $4 trillion of new money. Before the crisis, the Federal Reserve balance sheet was about
under $1 trillion.
It was 800 billion. That's right, and today it's over $4 trillion. So they've almost they have quadrupled the size of their balance sheet. Well, we know they did that, but they did so much more. They guaranteed every money market fund in America. They guaranteed every bank deposit in America, regardless of size. There was a $250,000 FDIC insurance limit. The Fed said, forget it. Whatever you got, $1 million, done, guaranteed. Money market funds, the Fed had no obligation to bail them out. Done, guaranteed. They did $10 trillion of swaps with the European Central Bank. And what was going on there? Well, the European banks themselves had been issuing dollar-denominated commercial paper, and that was being bought by money market funds to get a little higher yield. Well, when the run on the money market funds, U.S. investors said, I want my money back. They started pulling their money out of the money market funds. The money market funds had to sell the commercial paper or not roll it over. Well, all of a sudden, the European banks couldn't roll over their commercial paper liabilities because the money market funds didn't want it. They started to go insolvent, but here's the problem. That was dollar denominated. They turned to their central bank and said, bail us out. Well, the European Central Bank can print euros, but it can't print dollars. Where was it going to get the dollars to provide the dollar liquidity because they had dollar liabilities? Well, the answer is the Federal Reserve printed up $10 trillion of dollars. The European Central Bank printed up $10 trillion of euros, and they swapped. And the Fed got the euros, and the European Central Bank got the dollars, and then they could use that to bail out their banks.
There was tremendous at the time that, and this is where a lot of the people that were expecting inflation got it wrong. There was tremendous upward pressure on the dollar because of those counterparty liabilities. But I don't want to. In the interest of time, I don't want to divert you because I really want to get to this. You laid out this aspect very methodically about how you are modeling the future based on everything we just discussed. What your projections are. What do you think?
Right. Well, my point is, the Fed took their balance sheet from $800 billion to $4 trillion. If and they took interest rates to zero. If in the meantime they had normalized interest rates, so they were 2.5% today, and they had normalized the balance sheet, so it was back down to $800 billion today, sitting here in 2017. I would have said, nice job, guys. You bailed out the world, you saved the world, and you normalized your balance sheet. That didn't happen. They didn't normalize. The balance sheet is still over $4 trillion. Interest rates are still close to zero. So whatever they did with respect to 2008, they haven't got back to normal. So what are they going to do when the next crisis hits? Are they going to take the balance sheet to 8 trillion, 12 trillion? Now, there are modern monetary theorists, people like Stephanie Kelton.
They're
Paul
crazy.
McCulley.
The MMTers. I mean, as a working theory, it's one thing as a theory to understand financial markets, but the practical sort of suggestions that MMTers give, I've never been on board with.
Well, I wouldn't say they're crazy. I would just say.
Well,
I disagree. No,
I don't mean they're crazy.
No,
I mean the ideas are nuts.
Look,
for me.
Me too. I mean, I've met a lot of them, and they're very nice people.
They are.
Professor Kelton's perfectly pleasant.
I had
Paul
Kelton
McCulley,
on my old show.
Richard Duncan, and
Richard's awesome.
They're all nice people, but
Wonderful guy.
I completely disagree.
Yes.
The idea that you can just go to 8 trillion, 12 trillion ad infinitum, there's no limit, is not true for two reasons. Number one, there'll be political resistance. I mean, there's already, right now today with the Republican Congress and a Republican in the White House for the first time in a long time, they're talking about audit the Fed, abolish the Fed. I don't think it's going to happen, but there's talk about that. But the idea that the Fed could just double down, go to 8 trillion, I think is nonsense. Number two, apart from the political resistance, there's an invisible confidence boundary. It kind of gets back to my uranium example. There's a point at which people just wake up and say, you know what, I'm out of here. This theater's on fire. I'm running out, and a lot of people are right behind me. I don't trust it anymore. You can't tell me that you can print ad infinitum and that's not going to destroy the dollar. So I'm getting out of dollars. I mean, what does the collapse of the dollar mean? It means that people don't want dollars. You might get them because somebody owes you a paycheck, or you're a writer, you get a royalty, or dividends, whatever. You might get dollars, but you don't want them. You immediately dump them for land, fine art, gold, silver, water, natural resources, Bitcoin, something else. So I don't recommend Bitcoin, but yeah, a lot of people are going into it. But something else other than dollars, and that's what I mean by the collapse of the dollar, which almost happened, by the way, in 1977. People don't remember, but back in 1977, the dollar was so unwanted that the Treasury issued Treasury bonds denominated in Swiss francs. They were called the Carter bonds, but nobody wanted that.
Poor Carter, man. Poor Jimmy Carter.
The Treasury borrowed money in Swiss. They were U.S. Treasury securities in Swiss francs. And people say, I'll take the Swiss franc. I don't know what it's going to be worth in dollars, but I don't care because I have more confidence in francs than dollars. So that's how bad it was then. It'll get that bad again. But my point is, we are now at the point where the next crisis will be exponentially larger than the last, and that's what complexity theory teaches us, that the worst thing that can happen in a complex system is not a linear function of scale. It's an exponential function of scale. And all that means is that if you triple the system, you don't triple the risk. You increase it by 10, 100, some factor. It's theoretical. You have to actually compute the factor, but it's a large multiple of the actual scale of the system. Well, if they barely hung on the last time, if they don't have the capacity to double down again, and if the next crisis is going to be worse for the reason I just mentioned, what are they going to do? Well, they're going to do two things that are different. And this is even people who think maybe there's a crisis coming or maybe the system is unstable, which it is. Even if you get that far, and most people aren't there, but if you do, people can't take the next step, which is to correctly assess the reaction function. So first of all, the liquidity is not going to come from the central banks because they're tapped out. Everything I said about the Fed, everyone else is worse. The People's Bank of China printed more money than the Fed.
The People's Bank of China and China's liability situation is off the charts.
I can be a pretty severe critic of what's going on in the U.S., but China's worse. Et cetera. European Central Bank, Bank of England, Bank of Japan, they're all in the same boat. So they're tapped out. They can't. So where's the liquidity going to come from? Well, there's only one clean balance sheet left in the world, and that's the International Monetary Fund, the IMF. They right now, by the way, the Fed is leveraged about 110 to 1, a little bit higher, 110 to 1, $110 of liabilities for every dollar of capital. And on a mark-to-market basis, they are occasionally insolvent. You have to update the math all the time because, obviously, but right now with yields higher, they certainly are much closer to insolvency, if not actually insolvent. And I've had this discussion with members of the Board of Governors who said, so what? Why do central banks have to be solvent?
Right. That's the MMT argument also.
Yeah, exactly.
That it's an illusion.
Yeah, I agree with that. So the central banks are insolvent or close to it. They're tapped out. They're leveraged 113 to 1 or more. But the IMF is only leveraged 3 to 1. So they have scope. They have capacity to expand their balance sheet, and they can. They work like a central bank, and they can print money. A lot of people don't know that. Their form of money is called the special drawing right, or the SDR for short. You say SDR to most people, they think it's strawberry daiquiri on the rocks, but it's the special. It's the special drawing.
Is that an
right.
acronym for strawberry daiquiri?
Well, maybe it is now, but the point being, and it's not complicated. I mean, international monetary economists, the relatively few who actually understand what we're talking about right now, Demetri, can't explain this in many cases, but it's actually quite simple. The Fed has a printing press; they can print dollars. The European Central Bank has a printing press; they can print euros. The IMF has a printing press; they can print SDRs and hand them out. The only difference is they hand them out to countries, not to individuals. So you and I will not have SDRs in our pockets. It's not what we call in Philadelphia walking around money. But it'll go to countries and then can be swapped for other forms of currencies used to pay bills. Highly inflationary. It's just money coming out of thin air. And that's where the liquidity will come from. It can't come from anywhere else. It's not coming from Mars. It's not coming from the dark side of the moon. There's only one clean balance sheet, it's the IMF. But here's my point. That will not be instantaneous. By the way, a lot of people don't know that the SDRs, when did they invent those? They're actually invented in 1969. Been around for a long time. The last time they were issued was August 2009 in the last crisis.
So I read that in your book, and I remembered it very well. And I also remember a speech that John Lipsky gave at the CFR, the deputy IMF, and I remember Geithner going to Copenhagen and the global warming. So I remember all of that. I remember my antenna was up big time. I mean, the stuff that you write about in this book, I corroborated it based on my own memory. But go ahead, I interrupted you there.
No. The point is that the crisis reached a absolute fever pitch. Again, we said September 15th, 2008. That was when Lehman filed for bankruptcy. But the IMF issued the SDRs in August and September 2009. In other words, it took them 11 months to get those SDRs out the door. Not exactly, a fire brigade that shows up at the fire in 2 seconds. That's because it's a multilateral institution. They got a executive committee. They got to talk about it. They got to take a vote, et cetera. Even if you did it on a crash basis, you turned to Christine Lagarde, who's the head of the IMF, and said, Madam Lagarde, the world is burning down. We need the fire truck now. We can't wait 9 months. It's got to take them at least 3 months. I just can't picture the IMF getting trillions of SDRs out the door in less than 3 months. So what are we going to do in the 3 or 4 or 5 months between the crisis and the SDRs when the central banks can't save us and there's no money? What they're going to do is lock down the system. They're going to say you can't have your money. So in 1998, the whole world wanted their money back. The Fed printed it and handed it out. 2008, the world wanted their money back. They printed it and handed it out. In 2018, if not sooner, the world's going to want their money back. Once again, they're not going to get it. They're going to shut down the system. They're going to close banks, close exchanges, close money market funds. And, when I say things like that, people roll their eyes and go, you're crazy. What are you talking
Cyprus.
about? It's Cyprus, it's Greece, it's India, it's Venezuela. It's happening all over the world. And it's what's called a bail-in. You're exactly right. But all the laws have been changed since 2008. So relatively few people know this. But, the problem in 2008 started with mortgages, but then when the liquidity crisis hit, the ground zero was the money market funds. That's what caused Bernanke and Paulson to walk over to the White House and say, Mr. President, you gotta fix this. But at the time, you could call your money market fund, sell your units, get the money wired to your bank account, access it the next day. Money market funds legally did not have the capacity to suspend redemptions. Now, hedge funds have always had that. I've read hundreds of hedge fund offering documents. I've never seen one that didn't have a suspension clause. But by law, you couldn't do it in money market funds. That changed. It changed last year. And now money market funds legally can suspend redemptions. You can call them up and your broker will say, sorry, house closed. You can't get your money. We'll get back to you. They're not stealing your money. They're just telling you you can't have it. They'll close the banks. They'll reprogram the ATMs. An ATM will give you, say, $300 a day for gas and groceries.
We have that right now in Greece.
Right. And say, well, what do you need more than $300 for? We'll get back to you. And so forth. And then the problem, I call this Ice 9. It's a tribute to Kurt Vonnegut, who wrote a great novel, short novel. Everyone should read it. It's hilarious, among other things. in the early 60s called Cat's Cradle. And Cat's Cradle was written around the time of the Cuban Missile Crisis, and a lot of people were concerned about, doomsday and the end of the world and doomsday machines and all that. And so his metaphor, he had a mad scientist named Honecker who invented a molecule, polymorph of the water molecule called ice-9. And it resembled H2O in every respect except for two. It had a boiling point of 114 degrees Fahrenheit, which meant that it was frozen at room temperature. And the other characteristic was if a molecule of ice-9 came in contact with a molecule of water, the water turned ice-9. So he created this thing. He put it in these little vials and gave it to his three kids. And then the plot of the thing is, what are the kids doing with the vials? But if you opened it and poured the ice-9 into water, that water would freeze. Then a stream, a lake, an estuary, the ocean, the whole planet would freeze, and all Earth on life would die. That was the doomsday machine. So I take that metaphor, ice-9, that was his novel, and I use it as a metaphor to describe the financial system. So what's going to happen when they shut down money market funds? Everyone's going to go to the bank. Well, you're going to have to shut down the banks. Then they'll sell their stocks. Well, you're going to have to shut down the stock exchange and so forth. In other words, the minute you shut down any part of the financial system in a financial crisis, the pressure immediately moves to a different part, and then you have to shut that down too. So sequentially, it's exactly like ice-9 molecules turning water into more ice-9, and the entire system will freeze. So that's the reaction function. People are not ready for that. They're not prepared for that. Of course, one way to prepare is get out of the digital system and get some physical gold, physical silver, land, fine art, things that they can't freeze, they can't hack, they can't erase, that will retain value. That's one solution. And get ready for this. And then, sure, the IMF will be deliberating and getting ready to print a bunch of SDRs, but you won't be able to get your money in the meantime.
How do you see that resolving? Because the biggest it's very, relatively speaking, it's much easier to freeze a financial system than it is to unfreeze it.
Correct. Well, a couple things. Number one, you won't be able to unfreeze it until you print the SDRs, and we're talking trillions of SDRs because that's what it will take. But that's going to require, a vote of the executive committee of the IMF, and you're going to get the governance of the IMF. How does the IMF work? Well, for big things, and this would, an issuance of trillions of dollars, trillions of SDRs, or trillions equivalent of SDRs. By the way, for those who may not know, right now an SDR is worth about $1.40. It fluctuates, but right now one SDR is worth $1.40. So 10 trillion SDRs would be $14 trillion equivalent. Something on that order of magnitude is what they're going to need to do. But for big things, you need an 85% vote. What that means is that if you control 16%, you can block it. You can't make something happen, but you can prevent something from happening. Guess who is the only country in the world with 16%? The United States. So the United States by itself can block any IMF action just by voting no, and that means all the other members together cannot get to 85%. Well, something very interesting is happening this year. The IMF operates on what they call quotas or voice, but it's just votes. What's your percentage vote? And they reset it every 5 years based on relative shares of the global economy. Well, this is one of those years. 2017 is a quinquennial reset year in terms of IMF voice. And the BRICS are looking at this and saying we don't have our fair share. The BRICS combined are about 22% of global GDP, but they only have right now it's 14.8% of the vote. So they're saying, hey, we got 14.8%, but we're actually 22% of global GDP. We need more votes. The IMF agreed at the annual meeting last fall. The IMF, and before that at the G20 meeting. G20 is really the de facto board of directors of the IMF. The G20 meeting in Hangzhou, China on September 4th, and then followed up at the IMF annual meeting in October, agreed. They said, yeah, Bricks, you're right. You need to get a larger voice. Well, they're not going to get 22%, but even if they got 2%, that would tip them over from 14.9 to more than 16, which means if the BRICS hang together and they're pretty cohesive and pretty well organized, they have veto power too. So what that means is that when you have to go for a vote to issue the SDRs to save the world, the BRICS are going to be able to sit there and say, we say no unless you give us what we want. And what do they want? Well, they want the end of the dollar as a global reserve currency. So from then forward, it doesn't mean dollars disappear, what it does mean is that from then forward, the SDR is the benchmark global reserve currency. Oil gets priced in SDRs. Major financial institutions report their finances in SDRs. So, I mean, the IMF has done their balance sheet in SDRs since the SDR was invented. Certain countries are switching to SDRs, getting away from dollars. Iran actually recently announced that they're going to start accounting for things in SDR. So this is already happening, but this will bring it all to a head. So the sequence will be financial collapse worse than anything we've seen before, incapacity of the central banks to deal with it, a bailout coming from the IMF at 3, 4, 5 months away, and in the meantime, ICE 9 lockdown, you can't get your money. This is plain as can be. You can absolutely see it coming. Timing is like an earthquake. You know, you study the San Andreas Fault. You know there's going to be a huge earthquake. You know it's a center for earthquakes. Do you know exactly when? No, you don't. But you're probably smart enough not to build your house on the San Andreas Fault. And that's what I tell investors. I don't, it's funny. Sometimes the feedback I get from investors, they're like, yeah, Jim, I hear you. You know, I agree with all this. I get it. But call me 3 o'clock the day before it happens, and I'll sell my stocks and buy some gold, and it'll be all good. And I say, I'm not going to know. I'm not going to know. I mean, I might see it coming. The indications and warnings my Geiger counter might start to, click a little louder. So I think I will see it evolving. I already see it now, but do I know the exact hour and day? No, I don't. But what I say to investors is, well, if you agree it's coming, what are you waiting for? Get ready now.
You're talking about a solution that's coming from a very centrally organized model, which is a very industrial type of system of organization politically and economically, a legacy of the industrial economy. Today, we have a much more decentralized economy. And I wonder, especially given the fact that here you're on the one hand you have, which is very much, these are the forces of globalization. This is the globalism. And yet we have politics in Europe and the United States which are populist, which are inward turning, which are moving away from the type of consensus that's required for the type of solution you're describing. So my question is, do you foresee this solution being implementable either in a sufficient time scale where it doesn't cause massive dislocations that are problematic, significantly problematic, or that it's even implementable at all?
Well, it's a really good question, Demetri. Let me approach it from kind of opposite ends of the spectrum. The first thing you said is that we're these forces of anti-globalization, nationalism, populism seem to be pulling away from what is, in my view at least, an overly centralized system. Now, it is true that more centralization might facilitate decision-making, but it also makes the problem worse. In other words, it is the problem. And my analogy here is the Fed, they're always, I talk to a lot of members of the Fed, they're always patting themselves on the back about saving the world after 2008. I was like, yeah, but you lit the fire. Like you're like a fire department. You're an arsonist with a fire truck. You light the fire, and then you show up in your fire truck, and you want pats on the back for being first responders. It's like, what about the fact that you're the arsonist? And so the centralization that you talked about is actually the problem. And so
I couldn't agree more.
So decentralization is the answer. Again, very simple. I use metaphors, but it's important for the listeners to understand that the metaphors are not just metaphors. It's the same mathematics, the same complex dynamic systems. And I would look at the avalanche. I call it the snowflake and the avalanche. So you're in the mountains. It's snowing day after day. The snow is piling up. It's windswept. An expert can look at that and say, you know what, that snowpack is completely unstable. It's going to come down. It's going to kill any skiers under it. It's going to bury a village. And sadly, we've had fatalities in buried villages, just in the last couple of years. These things do happen in the real world. You can see it's going to happen, but you don't know when. And then one snowflake comes along and it disturbs a few others, lands the wrong way, creates a chute, creates a slide, creates momentum. And all of a sudden, the whole thing rips loose and the avalanche comes down and buries the village below. First of all, who do you blame? Do you blame the snowflake or do you blame the instability of the system? I would say look at the system because...
Or the villagers.
They're the victims. So that's us.
I'm just
they're the taxpayers and the investors, right? But I would say... if it wasn't one snowflake, it would have been another. If it wasn't today, right, it'll be tomorrow. So don't blame the snowflake. Blame the instability of the system as a whole. But in the real world, what do ski resorts do about this? Well, you go up to Aspen Highlands at 7 o'clock in the morning, And the ski patrol was up on the ridgeline in the Y Bowl setting off dynamite and shooting off cannons. And of course, they do this all over the world. What are they doing? They're descaling the system. They're causing little avalanches so you don't get the big out of control.
Like controlled forest fires.
That's the equivalent of breaking up J.P. Morgan. Breaking up J.P. Morgan into 5 banks or 10 banks, preferably, so that if any one of them fails, it's like, hey, too bad for the stockholders, but you're not taking down the system. That would be an example of setting off dynamite charges to cause a small avalanche so you don't have the big out of control one. We're not doing that. And in fact, we're doing the opposite. We got snow. Snow, blowers building up more snow.
That also relies. I'm sorry to interrupt. That also relies on. I mean, what you're describing, of course, is a solution to centralization being caused by. A solution to centralization being proposed by a central sort of system. Do you have any faith in the innovations happening in financial technologies, distributed, nonlinear, peer-to-peer technologies in finance that can do a sort of end run around this, if not in the United States, then maybe in certain developing countries that have less centrally organized governments that are more disorganized?
Not really. I mean, in theory, a very widely distributed financial system where we didn't have big banks, we just had a bunch of websites and crowdsourcing, and I could put loans on display, and people who were interested in investing them could fund that, and the borrower would get the money. I mean, that's lending, Lending Club and SoFi, and there are a bunch of others like that. First of all, they're tiny compared to the financial market. So,
right.
Good technology. They've got these sky-high stock multiples, fine for them, but they're really small. And what they're discovering in that model is what bankers have known for 500 years, which is you have to do your credit homework. There are 2 solutions to credit risk. One is do it well. That's how I started my career at Citibank. We went through. I walked in the door with a law degree, and I got a second law degree while I was there. But I had to take credit training, just like every other junior officer at Citibank. We had credit in our DNA. It got drilled into us. That went away probably by the late 80s, 90s. The reason was securitization. If I make a 5-year loan and I can wrap it in a security and sell it to some sucker, why do I care if it goes bad? I just want to get it out the door. So securitization was the end of credit. When I was a banker, you put a loan on the books, you had to keep it there. And in those days, people didn't change jobs every 6 months. You thought you were going to be around when the loan paid off, and if it didn't, that was going to affect your career. So we took it pretty seriously, but that's all gone. That's ancient history. So the credit culture is gone, but the other solution is the one I mentioned, which is do it well or do securitization, get it off your books, hand the hot potato off to the next guy. What these peer-to-peer lenders are discovering is they didn't do a lot of credit risk. They just sort of put term sheets out there and let investors, they kind of, like crowdfunding, in effect, a little more sophisticated than that. But those defaults are starting to pick up. They're starting to see losses come through, and those business models are being called into question. There's no escaping the credit risk. You can hand it off to the next guy, but someone's going to take the loss, and they're small. So for all those reasons, but even if you extrapolate that, they said, hey, come on, Jim, it starts out small, but look at Amazon and look at Google. I mean, they started out small and now they're big. And isn't that a solution? My answer is we're not going to get there. If that evolution took 10 years, we're not going to make it 10 years. If it took them 10 years to be a significant, decentralized, theoretically more stable arm of the financial system, we don't have that much time.
All right. So we're going to need to wrap this up, but let me ask you one last question. Do you think, given the policies of this administration, the rhetoric of this administration, do you expect that we might finally get the long-awaited inflation that central banks have wanted? Is that something that you think we're going to see with the Trump administration? I
think we will, and here's why. You go back to, in 2008, it's a good place to start with with QE1, QE2, QE3, trillions of dollars of money printing. We talked about all that. And a lot of people, particularly the Austrian economists and a lot of observers said, we're going to get the inflation. Here comes the inflation. They're printing all this money. Money printing equals inflation. And the answer is no, it doesn't. You need 2 things to get inflation. To me, it's like a ham and cheese sandwich. You can't make it with the ham. You need the ham and the cheese. Money printing is part of it. Yes, the money printing, it does have inflationary potential. But the other part is velocity. That's the turnover of money. It's like you can print all the money in the world, but if it's just sitting there in the banks, which it is, and not being loaned, not being borrowed, not being spent, not turning over, you don't have the velocity of money you need to actually cause the inflation. So you need the ham and the cheese. You need the money printing and the velocity. We have the money printing big time. Velocity is plunging.
That's the fiscal spend side.
Well, it's not. It's the turnover. So, for example, let's say we're in New York. And let's say I take a taxi home and I tip the taxi driver, and the taxi driver goes to a gas station, buys some gas, and the gasoline station owner takes the money out of the till and buys a present.
Ignacio knows all about that from Buenos Aires because they were sitting with the radios in the cafes, right?
Yeah,
Ignacio.
and the gas station guy buys a nice present for his wife. Well, in that example, my dollar has velocity of 3, right? We had a taxi tip, a gasoline tank, and some flowers for the wife. So it had velocity of 3. What if I stay home and watch TV? My money has velocity of 0, right? Because I'm not spending it. So I like to remind people, the Fed printed $4 trillion. That's true, but 4 trillion times 0 is 0. In other words, if you don't have velocity, you don't have an economy. Guess what's happening to velocity? It's plunging. Has been since 1998. Interestingly, same year as the long-term capital management crisis. It was not a specific function of the 2008 crisis. It's been plunging since 1998. So you can understand monetary policy for the last 10 years as a desperate struggle between increasing money supply and decreasing velocity. So you're multiplying a larger number by a smaller number and getting the same result. And that's why the economy has been so punked. That's why the GDP growth isn't what it should be, even in nominal terms.
You're loading the slingshot. Go ahead.
We're loading the slingshot. Having said that, what will it take to change? Because velocity is psychological.
So freaking scary. Jim, I got to say something, man. I got to say something. Honestly, man, I haven't spoken to anyone about this in so long. And I hope our audience is able to appreciate what we're describing here, which is a system that, as we said, is complex. It has many moving parts, and you have authorities and expectations about authority trying to push on one part of the system, and literally it's like throwing all your weight into a punch and missing, and then you're flying out of the arena. We're so unprepared for those non-linear effects of our actions. Anyway, continue.
Well, I agree with that completely. But my point is, we're not guessing. You can see it coming. We have the equations and the metrics and the experience and the history and the psychology to actually figure this out. It's just that the people in charge are not doing it that way. They're using these obsolete equilibrium models and value at risk, which are just wrong. But coming back to this psychological change, so I'll wrap up here because I know we have to finish up, Demetri. Right now, as we speak, President Trump owns the Federal Reserve, owns it. He is looking at the greatest transformation of the Federal Reserve, at least since 1952, which was the end of the Treasury Accord of financial repression, and maybe going all the way back to 1913 when Woodrow Wilson signed the Federal Reserve Act and got to pick the original governors. Right now, today, there are 3 vacancies, 2 empty seats, and 1 Dan Tarullo just announced he's resigning effective April. So call that 3. So there's 3 empty seats right there. There's actually 1 Republican on the board right now, Jay Powell. You don't hear much about Jay Powell. That's because he's outnumbered by the Democrats. But you stick 3 Republicans on the board, all of a sudden Jay is going to have some friends to play with in the sandbox. So you're going to have 4 Republicans. There are only 7 seats on the board. So you're going to have a majority of 4 Republicans by the spring. And it gets worse for the doves because, or at least for those who think they're in charge, because Janet Yellen's term is up January 28th. Now, Trump's already said he's not, at the end of January, Trump's already said he's not going to reappoint her. I think we can take him at his word. Well, if her term is up at the end of January, which it is, he's got to announce the new chairman by December at the latest because you got to go through a confirmation process and hearings and all that. He might announce it even sooner. The minute he announces it, she's a lame duck. It's like pulling the rug out from under. So there's 5, right? Like 3 vacancies. Jay's already a Republican, and Yellen's, there's 5. Stan Fisher's term is up in June 2018, which is only 14 months away or so. So the point is, you're going to get 6, and there are only 7 seats. Poor Lael Brainerd is not going to, it's like she's going to think she showed up at the wrong boardroom. So the point being, Trump is going to get 3, 4, 5, 6 out of 7 seats very, very quickly, 3 of them immediately. And so the board's going to do whatever Trump wants. So as an analyst, all you have to do is ask yourself, what does Trump want? Well, you already told us. He wants a cheaper dollar, right? He thinks the Chinese and the Germans and the Japanese are manipulating the currency. This is Currency Wars, by the way, not my first book. He's accused them all of currency manipulation to weaken their currencies. So he wants a cheap dollar. And Steve Mnuchin, who is the new Treasury Secretary, said the same thing. Well, if you want a cheap dollar, you're not going to raise rates. That makes the dollar stronger. So I would expect these appointments to be dovish. It doesn't mean they're going to cut rates tomorrow, but they're going to be in no hurry to raise them. And I think finally you'll see the change in psychology. The message will sink in. People go, hey, President Trump means business. He controls the board. We're going to get a weaker dollar. That's inflationary. I'm out of here. Get me some gold. Get me some silver, et cetera. Then we'll see the psychology change. And the thing about change psychology, it's really, really, really hard to change it. But once you do, it's equally hard. It's equally hard to change it back.
Absolutely.
And so now inflation won't go from 1.5% to 3%. It'll go to 9%. We'll be back to the 70s. So back to the future.
Same exact issue about lowering the slingshot. So pretty much the only thing then that would throw a wrench in that model is extraneous factors that can affect the longevity of the administration. Stuff like the recent sort of fights between the Trump administration and the intelligence community, but we'll see. Jim, thank you so much for coming on. I didn't know how I wanted to structure this because every time in the past when you've been on my show, we've always talked about current events. I really wanted to do a big breakdown, but I hope to have you on again before too long, and I want to try and do it at a time when it's most sort of relevant to the time period. But man, thank you so much.
Thank you, Demetri.
So much.
Good
It's great seeing you.
Thanks.
Thank you. And that was my conversation with Jim Rickards. I want to thank Jim for being on the program. Today's episode was produced by me and edited by Connor Lynch. Sound engineering was Ignacio Lecumberi. For more episodes, you can check out our website at hiddenforcespod.com. Join the conversation on Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforcespod.com. Thanks for listening. We'll see you next week.